Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day, let's get you the three catalysts we're watching this hour. First up, we'll break down the market action with stocks dropping as the Fed fails to reassure investors on growth and inflation. Plus, we'll dig into the inflationary impact of tariffs as Piper Sandler downgrades auto stocks on political uncertainty. And the IPO market rattled by the market sell-off. CoreWeave shaving more than $1 billion off its valuation amid the volatility. We'll have more on that next. Half an hour into the start of U.S. trading, let's get you a check on the markets brought to you by Tasty Trade. You're taking a look at the major averages flipping back into the green. So here's what happened. You had the Fed meeting, then you had markets moving to the upside, huge relief as we've seen a lot of selling recently. But then pre-market today, you had a lot of selling coming in. And now finally, just in the past couple of minutes here, flipping back into the green. You've got your tech-heavy NASDAQ up about 0.2%, your S&P 500 up about 0.1%. It'll be interesting to see whether we can get a bid in some of those tech names today, especially off the back of Quantum Day for NVIDIA's GTC conference today. Will that lead to further movement to the upside in your tech-heavy names? Of course, we'll monitor all of that for you, but let's flip it over to the bond market for now and see if Treasury is still catching a bid. You've got your 10-year still down under that key 4.2 level, continuing to move to the downside as you continue across the curve there. And then finally, let's take a look at Bitcoin. Risk-on sentiment taking its place in the market today. You got Bitcoin steadily above that 85,000 level. Well, I want to welcome in my guest host for today, John Hilsenrath. He's a senior advisor at StoneX and a visiting scholar at Duke University. John, I'm really excited to talk to you about the Federal Reserve. Obviously, as a reporter, you have a lot of insight into the Fed, but also you conducted this study alongside Duke of ex-Fed officials.
Right.
They seemed more transparent with you about the path forward for the Fed. Fed Chair Jay Powell, one of my favorite quotes from him yesterday was, I don't know about the dot plot. Why don't you journalists in the room do the dot plot for us?
And to me, one of the most interesting things he said was that there's some inertia in the Fed's not only forecast, but their reaction function. When you don't know what's going to happen next, your instinct is to just stay put and wait and see. Mm-hmm. What I did and what I'm doing with Duke University before this meeting and what I'm doing before every update of the Fed's summary of economic projections is asking the people who used to work there, who used to be part of this interest rate setting process, all right, what do you see? And what we saw was similar than the Fed's, but they leaned in a little bit harder. The median of their forecast was for one rate cut this year and not two. Mm-hmm. So their median went up. They saw more inflation, not only this year, but they leaned into it persisting into next year. So the Fed has the inflation rate coming down by next year. So the Fed is saying transitory. The ex-Fed officials that I surveyed said, no, it's not going to be that transitory. We're going to see some persistence into next year. And they also see growth slowing next year. So the next couple of years of sub 2%. Economic growth. So they see more of a shock from tariffs and uncertainty than the Fed has penciled in. But as you say, Powell's, acknowledged that they kind of want to wait and see before they I was saying that they should write down these estimates in pencil before they put it in hard ink. They're waiting to see how things play out.
And then obviously you had the president coming out and saying that they should have cut rates in anticipation of tariffs. One of the things I was excited to talk to you about is this interplay between fiscal and monetary policy, right, and the idea that, well, if they did cut rates, maybe that gives the president too much leeway on tariffs because then the market is cushioned by a cut of interest rates and they can handle tariffs. How much does Powell have to make sure he's kind of walking that thin line so that he doesn't tip the White House?
Well, I mean, again, this is what Powell is trying to say is because he doesn't know what the fiscal policy is going to be. They're in the middle of that debate between the White House and within Congress, within Republicans in Congress. It's hard to say what interest rates are going to be because they've got to see what the fiscal policy is going to be, how stimulative the fiscal policy is going to be to growth and inflation. As we saw in 2021, 2022, when fiscal policy is too loose, that could cause an inflation problem, and we got one. We don't know where Congress is going to come out. There's a lot of talk in Washington right now about cutting spending and reducing budget deficits. But if you look underneath the surface, I don't see it. So the budget resolution that the framework for the budget resolution that the House passed earlier this month penciled in or wrote in ink $2 trillion budget deficits a year, every year for the next 10 years. So they're not reducing the budget deficit. If I'm the Fed chairman, and I'm not, I'm looking at a 6% of GDP budget deficit and saying, I don't want to be too loose on interest rates right now.
Right, especially just given the broader concerns about growth slowing down. And then you also have inflation, you have the stagflation question, a lot of
and this is where I think it all comes together with fiscal policy, and you're talking about the 10-year note today.
Yeah.
I think it all comes together in the 10-year note, because the big question for me is, are these $2 trillion budget deficits, is the market finally going to get indigestion from these really large budget deficits? You know, the Fed has already cut interest rates by a full percentage point, and the 10-year yield is higher now than it was back in September. If Congress and the Trump administration aren't serious about cutting the deficit, I don't think there's much farther lower that we're going to see 10-year yields get unless there's a real shock to the economy and we hit a recession.
And that shock maybe comes from policy from the White House. We're going to continue the conversation throughout our show today. Stick with us, John. Thank you so much. We're going to turn now to small caps. Despite some euphoria around smaller companies heading into 2025, the Russell 2000, as you can see that blue line there, dragging even lower than the S&P 500 year to date. Joining us with what's next for the small caps trade, we've got Brian Vendick. He's the Chief Investment Officer at MJP Wealth Advisors. Brian, great to have you. I was excited to talk with you because the last time you were on heading into the new year, you told me you were excited about small caps heading into 2025. What happened?
What happened, I think, is the uncertainty that we've seen from policy decisions perk up over the last couple of months, and the change in sentiment on some of the soft data that came out about 30 days ago, and it kind of persisted with investor sentiment that there might be a slowdown in the economy. And as you both were talking about the revisions for U.S. economic growth, that has kind of trimmed back, I guess, that investment thesis in the short term on small cap stocks, Madison.
So where are you on small caps today and the path forward for small caps for 2025?
Yeah, I mean, from a valuation point of view, we are still constructive or positive on small caps longer term. I think you normally see smaller companies kind of take it on the chin in the short term and are the first to recover as you're kind of coming out of concerns around economic growth. The fact that we're in this period of time of uncertainty, as Powell said yesterday, I think 18 times in his 60-minute meeting with reporters, the concerns about economic growth moving forward it's what's weighing on the sector. But I think when you look at overall price to earnings ratios and valuations for small caps and mid cap stocks, there's still an opportunity here. And a lot of the earnings growth forecasts for profitable small cap companies are still intact. So definitely something to be cautious about in the short term. But if you're a longer term investor, I still think this is an opportunity when you think out 1 to 2 years, considering a slow growth economy.
Brian, I want to follow up on what you're saying about valuations. What is the value story of small caps right now when you're looking at PE ratios or whatever value estimates? And with the rally we're seeing in Europe these days, are we seeing this desire among investors for value showing up not in small caps in the United States, but in value stocks outside of the United States?
Yeah, that's a great question. I think on an overall basis, because of the uncertainty and because of valuations being higher in mega cap tech, which, as we know, the last couple of years obviously have led the market higher, and that concentration risk that existed in the market as we entered into 2025, that's why you're seeing a investment in any areas where value from a PE ratio is 18 or less. And so when you look at it from a U.S. point of view, the small cap stocks are trading around, 14 on a PE handle, while, value stocks in the large cap space are around 18. And when you look at stocks outside of the U.S., you're in that 14 to 15 range. And I think the reason why in the short term, especially over the last 30 days, international equities have caught a bid is because of these potential policy decisions that are going to decouple the United States from that global interrelationship of trade, that these countries realize that they need to fill the room if the U.S. is taking a step back and reinvest domestically. And I think investors are seeing that as a potential longer term growth trend for non-U.S. developed economies versus the US. However, I think in this environment, because so much is moving around and especially will continue to move around, especially after April 2nd, when we understand what does reciprocal tariffs really mean, I think this is the whole reason why one should stay diversified between areas that look for value opportunities, but at the same time, I would say don't give up on the mega cap tech AI innovation trade just yet.
So if you're not giving up on the mega cap tech trade, what does that mean for smaller tech names? And I guess in terms of a thesis for small cap investors, can they afford to own the basket of small cap names, or do they have to be selective within areas that they might see the most growth, which maybe is tech?
Well, I think not to hedge our bets here a little bit, but, from our view, it makes sense to have exposure to the small cap value sector, where you definitely have companies that are more profitable as a means to kind of muscle through this volatility that's probably going to continue over the next several months. But at the same point in time, on the growth side, on the innovation side, I still think that makes sense as well, because as I said before, the valuations are attractive. So areas within the small cap sector are names that are more kind of software focused, I believe, that are going to help to support improving the productivity of deployment of software enhancements, of AI innovation. But at the same time, I think when you think about a supply chain that's changing and an insourcing and a new way to think about logistics as a means to combat some of these policy decisions, think about the industrial space, think about still investing in infrastructure, and also other areas of the small cap space that can actually help companies save money and protect margins.
All right, Brian, thanks so much. Appreciate it.
Thank you.
Let's get a check of the markets here, continuing to move to the upside. You've got your S&P up 0.2%, your tech-heavy NASDAQ carrying the majority of the gains, up about 0.3%. One potential explanation for the buying that we are seeing, U.S. February existing home sales rising 4.2% to 4.26 million. That is above all estimates. The estimate for existing home sales under 4 million, again coming in at 4.26 million here. Existing home sales up that 4.2% after falling 4.7% the prior month. Now the median home price, that's what you want to hear, rising 3.8% from last year to $398,400. So you don't want to hear that increase in prices, but it is perhaps good news for the market that we are seeing this increase in existing home sales. Inventory also rising to 1.24 million homes from a month ago. Also interesting, first-time buyers making up 31% of total sales. We've seen a depression in first-time buyers in particular. Interesting to see that return to the market. We'll have all of this and more for you ahead on Morning Brief.
Seasonality trends suggest the stock market finally turning bullish this March with volatility quieting down. So let's take a look at how things are setting up. I'm Jared Blickery, host of Stocks in Translation, and let's get to our first chart here. I've showed this at the beginning of March. I have two different models. They're each bottoming in March at different times here. The first one, which is similar to a number of the ones you've seen around the internet, especially Ryan Dietrich's work, that was last week around March 11th or so. What this is showing, we are seeing a little bit of a bottom here, things inflecting up on March 19th. And guess what? That was after Fed Day. And so that's what we're taking a look at right now. Now, this is only March, and I thought it'd be interesting to take a look at an update of our VIX model. And remember that when the VIX goes higher, that usually means stocks are going down. So this is kind of the opposite, but it's really mapped out closely to the year as it's progressed so far. So in the white here, I have the average VIX price since 1990. And in green, I have what's happened this year. And you can see this little spike here, kind of front ran this spike here. And we did get this green spike here, would actually happen in 2025, just a little bit early. But you can see volatility now coming down nicely as predicted by the model. Doesn't have to follow it exactly, but if it does continue following it, we would expect this to be bullish for stocks, because you take that pressure, that selling pressure from the options market off of stocks. Now, switching gears, I thought we'd also take a look at Apple seasonality. This is something that I haven't shown in probably a year or two, but this white line is the Apple seasonality going all the way back to 1981, which was its first full year of trading. And in green, I have what's happening this year, and you can see it's been kind of a negative year. What I like about the setup right now is it's kind of hard to see here, but we have a bit of a bottom setting up right around this time period, and then we have this nice trend up just into the end of May. Then we have a little bit of a decline, a little bit of a bottom here. Then we have another potential rally, and this kind of zigzags up into the end of the year. So this first, this signal right down here, this is kind of the first major buy signal for Apple. It doesn't have to happen this way, but I thought it would be also interesting to look at another model. So instead of looking at history all the way back to 1981, we'll just do 20 years because maybe recent price action is showing something different. So in blue here, I have the since 2005 model. And what's interesting is they track each other, these two models, pretty closely. So I can zigzag my way up here, and they are in agreement. So put it all together, finally stocks starting to get that tailwind instead of a headwind from seasonality. And it's not just in stocks generally, it's also in Apple. And so for more on this, tune into Stocks in Translation for more jargon-busting deep dives. New episodes Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
All right, Jared, thank you so much. Appreciate it as always. CoreWeave has officially reported the launch of its IPO. The cloud computing provider that is one of the hottest startups in AI is seeking to raise about $2.7 billion in its IPO. That is below the $4 billion it was initially seeking, coming amid market volatility. So what does this tell us about the state of the IPO market? Joining us now, we've got Avery Marquez, Renaissance Capital Director of Investment Strategies. Avery, great to have you on. Thanks for coming on with us so quickly off the back of this breaking news. Just curious your thoughts on the drop in valuation from CoreWeave. What does that signal to you?
Yeah, it's interesting for CoreWeave especially because that initial estimate, I saw reports for that at the end of February. So just a month before this launch, and even while this market sell-off was already underway. So it is a bit surprising to see it drop by so much in such a short time, but I don't think that it indicates any less demand, probably just some caution. And I don't think that this will be the last company we see do something like this in terms of valuation.
Well, let's go there. How are you expecting this to bleed out to other potential IPOs?
CoreWeave should definitely reignite some interest in the IPO market and encourage some of these larger issuers we've seen filing to test the market now. Its performance will be a solid indicator for other companies that are looking to go public, and will also be a solid indicator for companies specifically that are targeting AI or pitching some kind of AI angle in their offering.
Avery, there's a lot of talk in political circles now and economic circles and markets about uncertainty. We hear it over and over again. We were just talking about this with respect to the Fed. Fed Chairman Jay Powell talked about uncertainty over and over again. Does this signal from CoreWeave suggest that because of uncertainty, we might see companies get second thinking their decisions to do IPOs? Or is there a chance that we could see companies pull IPOs in the months ahead until these uncertainties get cleared up a little bit?
Mm-hmm. Yeah, it's no surprise that volatility, uncertainty is not great for the IPO market. Companies want a nice stable market to price their offerings. But I think with this CoreWeave launch, as well as, like I mentioned, those other companies joining the pipeline recently, even during this market sell-off, Mountain, Hinge Health, Klarna, we should still see companies going public because there clearly is interest and demand from companies to go public, whether it be for cash liquidity needs. But I do believe that there is some component that investors are interested in these deals still. Time will tell if we start to see companies pulling plans, but I think it is a good sign that with this really steep drop we've seen, we haven't seen more headlines saying that companies aren't moving forward with their IPO plans this year.
So what does the pressured overall market environment right now mean for potential shareholders for these companies like a CoreWeave that is set to IPO? Is there a potential here for investors to be getting shares of these companies at a little bit of a discount, just given the market volatility that we're seeing right now?
That is probably something at the forefront of public investors' minds, and I think it has been for the last 3 years. Public investors want companies coming public at fair valuations, at a discount to their public peers. So, it is possible. I think depending on how we see the market move over the next couple weeks, that will tell us more about what public investors can expect from CoreWeave and from IPOs in the coming months.
All right. Avery Marquez, thanks so much for joining us.
Thank you.
We're going to get to some trending tickers now. Taking a look at auto stocks today as Piper Sandler issuing a slew of downgrades and price target cuts, except for one notable EV maker. The analyst slashing price targets on Rivian and Stellantis, saying, quote, for most stocks in the car manufacturing supply chain, there's too much political uncertainty to make actionable recommendations. However, the analyst reiterating an overweight rate on Tesla, saying the drama is nothing new. For most stocks in the car manufacturing supply chain, there's too much political uncertainty for actionable recommendations again. So I think what's really interesting here, obviously, is that this is the latest admission that there are going to be certain sectors of the market that will be negatively impacted by tariffs. Obviously, they say Tesla is not part of that, which is interesting.
Right, yeah.
They also talked about how used car names like Carvana, for example, could be beneficiaries of the tariffs as people look for cheaper cars on the used car marketplace. But what stood out to you, John?
Well, the used car point is interesting because what we saw during the supply chain disruptions of 21, 22 was a flood of people into used car. Used car prices went dramatically higher. But I think you have to take the Piper Sandler example on cars and look at other industries. What does this mean for forestry, for trucking in particular? And basically anything that involves commerce and transportation between the U.S., Canada, and Mexico, I think, is going to get caught up in this. And those are three names right there, three industries that I think you have to consider pretty carefully. And then also obviously metals.
Right, and it might be an example of more of the market action that we're going to see as we do get clarity on those reciprocal tariffs come April 2nd as well.
Yeah, and then, again, we just keep hearing these words over and over again. What struck me about the Piper Sandler recommendation was how much it echoed what the Fed said, which is that given uncertainty, it's hard to make recommendations.
Yeah.
People, people kind of get stuck in their place when they're not sure where things are going to go yet. Everybody freezes until they see how things are going to play out. And I think this is going to be a theme for 2025 overall.
And perhaps for investors, finding areas of the market where you can be certain is the only.
Well, but also if this is happening at the Fed and if it's happening on Wall Street, it's got to be happening in boardrooms too. When you think about hiring and when you think about new investment strategies, do you want to put that plan in the U.S.? Do you want to go ahead with your build out in Vietnam or Thailand? Everybody wants to see how this is all going to play out. And it's why I think the strategy of confrontation between President Trump and the rest of the world kind of is slowing down the process, the economic wheels at a time when he proposed a pro-growth strategy to speed up the economic wheels.
I mean, you can take it even further. If it's happening in boardrooms, it's happening at Delta, Verizon, all these companies saying that they're pausing CapEx due to the uncertainty. It's happening in households,
and
right?
It might be that as these things become clearer, that the gears will start turning again very fast. But right now, I think we're in a slow growth period, and it's going to be like this until all these different uncertainties get sorted out over the course of the year.
Does April 2nd give us that clarity?
No.
Yeah.
No, because as we saw in February and March, that can change on April 3rd or April 4th. And then, once the reciprocal tariffs get sorted out, if they do, then you move on to China.
Right.
And the big story, I keep referencing 2018 as like my reference point for 2025, because that's when the tariff story was big. 2017 was all about tax cuts. 2018 was all about tariffs. That was all a China story. And the S&P 500 fell as much as 20% during those negotiations. So I think it's a strap in. We're on a roller coaster year.
All right, well, stick with us through that roller coaster because we're going to have all of your markets action ahead here on Yahoo Finance. Stay tuned. You're watching Catalysts.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation.
Transitory is back. That was Fed Chair Jay Powell addressing the uncertainty that's looming over the FOMC amid changing policy coming from the White House. President Trump reacting to Powell's presser on Truth Social, saying, quote, the Fed would be much better off cutting rates as U.S. tariffs start to transition and ease their way into the economy. For more on what's next here, we have Terry Haynes. He is the founder of Pangea Policy. Terry, great to have you on here. Just want to get a sense of what you're telling clients about whether or not tariffs and the inflationary impact of those tariffs are transitory.
Well, I think you got three things here. You have what Powell said, which I won't repeat since you've just run it. Secondly, I think you've got what the Trump advisors say, which is the Trump, Bessent, and Lutwick, I think, are all saying that any impact from tariffs are far outweighed by the rest of the economic policy agenda that comes later this year. Tax cuts, pumping up manufacturing, deregulation, energy dominance, as they call it, and defense spending and so on. So you've got that. And finally, I think the markets believe that as well. But what the markets are frustrated about is frankly the timing, that you've got kind of a tariffs negative to unknown on the early side with the vast majority of the good stuff coming later.
So talk to me about that good stuff coming later. What are you telling clients about how likely that is? Because obviously the good stuff we're referring to is the tax cuts, but there's concern that it's just going to be an extension of the same. And if we don't get more depth in tax cuts, that the market is not going to be happy.
Well, my call right now is that it's 80% likely that the market sees tax cuts in the fourth quarter of calendar 2025. Not only that, but the tax cuts are going to be very, very big because what Congress is moving towards now, and I've been talking to markets about this for a while, and it's only recently that outlets like the Wall Street Journal have started to pick this up as well, is that they're going to move to a what they call a current policy tax cut baseline that essentially allows them to cost this thing at zero, which means that the tax cuts are maximized and the pay-fors are minimized. So they're going to push for that. And another reason why I say it's going to be 80% likely is because you can look at the government shutdown business of last week as kind of a dress rehearsal. And what you saw is Trump and Republicans staying together. And I think markets took from that a positive sign that these folks are serious about moving the rest of the economic agenda forward.
Terry, it's John Hilsenrath here. I want to drill down a little bit on the fiscal outlook. I think a lot of people hear some of these phrases and the debates in Washington about pay-fors and baselines, and their heads spin. What I see when I look at what the House passed in its framework for a budget earlier this month was $2 trillion budget deficits every year for the next 10 years, which amounts to about 6% of GDP. Which, in my mind, is a fiscal policy that's totally irresponsible at a time when we've got unemployment so low and an inflation rate so high. So my question to you is, well, how do you see the market, and what are you telling your clients about how this fiscal policy is going to affect the supply of Treasury bonds and yields on 10-year Treasury notes? Because I don't see how this comes together. I don't see how the market gets the tax cuts it wants unless they're serious in Capitol Hill about doing spending cuts. And I don't see it in the House framework right now. The House framework has $2 trillion budget deficits penciled in as far as the eye can see.
Right, and good to see you, John. A couple of things. One is, I'm with you that this isn't a serious attempt to cut debt and deficit. That was never going to happen. You had two political parties even last year The one political party, the Democrats, wanted to continue spending without end. The other political party, the Republicans, in the Congress, their view was, look, we should cut 1% out of 30% of the budget, which is discretionary spending, and not touch the 70% that's mandatory spending. So there's not political will here, and I think there's not going to be political will here. When you're talking about a world in which everybody understands that some efficiencies have to come out of Medicaid, for example, and the president doesn't have Congress's back on making those efficient savings to Medicaid. The president's view is Medicaid shouldn't be touched. Then you're in a situation where debt and deficit are really not going to be lessened at all. My view of this is that, and this is why the baselines, as I know, they make a lot of people's heads spin, but you know them very well, and so do I. This is why the baseline issue, even though it's kind of a nerdy thing to point to, is important, because if they take current policy, then the pressure to cut on pay-fors is much less, and gives them a lot more headroom to increase the tax cuts. Their bet, Trump's bet, Congress's bet, is a very large political bet that that tax cuts, if they're large, turbocharge the economy a great deal, really help politically, of course, but beyond that, pump up this whole American economic exceptionalism story, and make the United States much more of a preferred destination for investment of all kinds as compared to the rest of the world, whether it be China, the European Union, or elsewhere.
So Terry, when you're talking to your sources in Washington and they're asking you how the markets are digesting all of this, I'm sure these are two-way conversations. What are you telling them about the bond market? Do you think the bond market will sign off on $2 trillion or more deficits as far as the eye can see? Do you think there's the capacity in the bond market to keep swallowing all these treasuries that are the likely result of the fiscal policies that are being formulated in Washington?
I think what matters more to them than anything else is the growth prospect, the economic growth prospect, number one. And number two, what matters is what the rest of the world looks like. And if the rest of the world continues in the relative doldrums and the United States continues to look like the preferred bet, I think they probably do end up swallowing it. Yeah, I mean, I sense them as very much in a wait and see kind of mode right now.
And Terry, switching gears a bit, the Fed's independence came up again after Trump's firing of those two Democratic commissioners at the FTC. I want you to listen to what Jay Powell had to say about this and get your thoughts on the other side.
Sure.
So I think I did answer that question in this very room some time ago, and I have no desire to change that answer and have nothing new for you on that today.
And that's Powell referring to that incredible line, not permittable under the law, when talking about Federal Reserve members being fired. Terry, is there a risk to Fed independence under this administration?
Well, first, Powell's right about the unfireable nature. Let me just say that at the top. Secondly, I can well understand why markets continue to be nervous about this. They were nervous during the first 4 years of the first Trump administration. They're nervous again now. The FTC firings, I think, increased that nervousness, and I wrote that on Tuesday night right after it happened. That said, I don't think it's very likely. In fact, I think it's almost impossible to have a scenario where Powell's actually removed or some other governor is removed, and I'll tell you why. Firstly, I think you've got a markets rebellion that would happen. Secondly, I think you've got a variety of advisors, not least of whom are Bessent and Lutnick, that would urge very strongly against doing anything like that. And finally, I think Fed independence, in the sense that the Board of Governors, the FOMC and the Board of Governors feel free to act as they wish I think has been proven, frankly. It's forgotten and not well understood by markets that right after Powell got confirmed in 2022 by a Democratic Senate, it was assumed by Biden and that Democratic majority Senate that the Powell Fed would continue to be dovish. The moment they were confirmed, they immediately went hawkish and confounded expectations, and it largely got inflation under control. I have no reason to believe that Powell or the governors would do anything different now.
Terry, one of my favorite pieces of political intrigue from the meeting yesterday was Governor Chris Waller's dissent. It's highly unusual for a Fed governor to dissent at an FOMC meeting. Waller was a Trump appointee during his first administration. What do you make of that dissent? I saw it as Waller's opening bid to get the job when Jay Powell leaves in 2026.
Agreed. There's always, you well know, John, there's always auditioning going on in Washington, and I thought that was a little bit of one.
All right, Terry, thank you so much for joining us. Really appreciate it.
Appreciate it, guys. Thank you.
Coming up, we're talking the health of the consumer, what a pullback in spending could mean for the restaurant industry this year. That's coming up next on Catalysts. The REITs index holding on to gains so far this year as the Federal Reserve remains committed to just 2 rate cuts. Now, this year, investors may turn to REITs for some income generation amid market volatility. Here with more on the landscape, we've got Richard Anderson. He is over at Wedbush. Richard, always great to speak with you about what's going on in REITs in particular. Talk to me about how the Fed's path forward could impact some of the REITs that you're covering.
Well, first of all, nobody controls the long end of the curve, right? So the important thing for the REITs is where does the 10-year reside, and certainly some implications from Fed policy impact that. But what we've been seeing is the 10-year sort of trending down this year, and that's good for the REITs that are dividend-paying vehicles. And so we've actually seen outperformance from the U.S. REITs so far this year, which has been a welcome change over the past versus the past couple of years. And so it's creating some conversation for us with the generalist investors that are having a look to see if this is a sector that could be a beneficiary of some rotation. Yeah. And that's where we stand today.
And Richard, you sent over some top picks for several areas within REITs, industrials, multifamily, and senior housing. I guess I'm wondering for investors who are more on the retail side of things, who maybe don't have a ton of investor hygiene and are looking at REITs as a way to play real estate without owning a home themselves, which area and which top pick of yours do you think is best for that kind of investor?
Well, so there's a very obvious opportunity, and it's important to make clear. The REITs, it's an industry that shares a tax code, but it's made up of 15, 17 different industries that bear no resemblance to one another. And that makes it interesting from my seat to make decisions within the REIT industry. One of them is the senior housing space. And so senior housing, really embedded into the healthcare REITs, is benefiting from the post-pandemic recovery of occupancy. There is a wave of demand coming because there's so much in the way of, the older generations growing at a faster clip than the rest of the population. The baby boomers will start turning 80 this year. So senior housing is a real obvious sector to own and maybe sleep well at night for the time being. And that's not to be confused with skilled nursing, which is a fully regulated sector that is funded by Medicare and Medicaid, which, we have some concerns about where that's going. Senior housing is private pay by the residents or the adult children that they're caregivers, and there's a real opportunity there. Ventas VTR is a name we really like, as well as a smaller cap version of senior housing, National Health Investors, NHI.
Richard, I want to ask you a little bit about the debt structure in the industry that you're covering. I imagine a lot of these institutions that you cover took out their loans when rates were very low in the early stages of COVID and right after. What's the rollover risk right there? At what point are we going to start seeing them rolling into higher cost loans? And are there any problems brewing on the financial front in this arena?
Well, one thing that's, a saving grace, I think, in my opinion, is the fact that there's so much financial liquidity in the system. And so while rates are higher, we don't see it as an enormous risk. No question, refinancing risk has already played a role in earnings growth over the past couple of years, and that will continue. That's just a fact of life. You're right that back in the heyday of low interest rates, the REITs locked in at the time extremely low rates that now are likely to roll up, and so 2 or 3, maybe 5 percentage points of earnings growth is taken off the table because of this. And that would be, 5% would be a very extreme level in terms of how this is all impacting things. And so, it's an issue, but not a major issue, in my opinion.
Right.
And sort of priced into valuation as well.
Right. Absolutely. Richard, thank you so much for joining us. Appreciate it.
Okay. Thank you.
Coming up, the health of the consumer, what a pullback in spending could mean for the broader restaurant industry and the economy. That's next on Catalysts. Darden Restaurants' revenue falling short of estimates in its fiscal third quarter. Still, sales were up more than 6% compared to a year earlier, boosted by the acquisition of Chuy's with more than 100 locations. Joining us now with more, we've got Peter Saleh, BTIG's managing director and restaurant analyst. Hey, Peter, talk me through this print because it's interesting. We're seeing some disappointment in some of the areas that typically see success for the business, like Olive Garden and Longhorn. What is your reaction to the results?
Yeah, so thanks for having me on. I would say the results for the quarter were kind of lackluster. They did miss by about 100 basis points on same-store sales. The EPS essentially in line. So I think the stock reaction is not based on what happened in the last quarter. It's more based on the commentary that they made for March, which suggested that so far in the fiscal fourth quarter for them, which is March, April, and May, they are trending above 3% same-store sales growth, and that is a meaningful acceleration in the two-year stack from what we just saw in the most recent quarter. So there's been an acceleration in same-store sales when essentially the sentiment among consumers is pretty negative. So I think that took investors by surprise a little bit this morning.
You've got a buy rating on the stock. What's your bull case?
So our bull case here is that this company can continue to invest in incremental advertising to drive same-store sales, primarily at Olive Garden and a little bit at Longhorn. They've pulled back significantly on promotions and advertising since COVID, and they've been bringing some of that more back online over the past several years. So that's primarily the base case for our buy thesis here. We also think the addition of the Uber Direct partnership is really going to drive some meaningful incremental same-store sales. They talked about seeing 40 to 50% incremental orders on the Uber partnership in the most recent quarter. I think that's only set to accelerate as we go forward with some incremental advertising.
Peter, can you help us put together some of the macro story here? On the one hand, as you noted, consumer sentiment is down. On the other hand, we're talking about an acceleration of same-store sales growth here at Darden. What's going on? How do those two pieces fit together?
So historically in this sector, it's job growth and income growth that drive same-store sales and transactions. And so long as we are seeing job growth and we're seeing incomes continue to rise, the restaurant industry should remain on a healthy footing. That said, Darden's numbers are outpacing the industry, so they're taking share. So that's the good news for Darden. I still think the industry is struggling somewhat, but generally speaking, probably the sentiment has not translated into a decline in consumer spending so far for the restaurant space. And
what are you seeing broadly in your sector on pricing and inflation? We've been talking a lot about egg prices going up so much. Now we're seeing the potential for avocados and tariff prices going up. Are you seeing any momentum on the pricing front?
So I think you're starting to see the restaurants, they're taking a little bit of price. They're being really reluctant to raise prices too much. There was a post-COVID, between FY19 and 2023, restaurant pricing QSR was up 40% or so, casual dining in the 20% range. Those numbers are far outsized. I think they're reluctant to raise prices too quickly here, despite what we're seeing as a little bit more inflation. Darden did call out that their fiscal fourth quarter would be, more inflation on commodities than they have seen in the recent past. So we're starting to see inflation on food creep up a little bit, but the restaurants are being a little bit reluctant, which is a smart move to take a little bit less price going forward.
The latest example of corporations being reluctant and uncertain. Peter, thank you so much. Really appreciate it. I also want to thank my co-host today, John Hilsenrath. Thank you so much for joining us, bringing us your insights on the Fed and all things macro. Really appreciate your time.
That was fun.
That was really fun. We'll have to do it again. Coming up, we got Wealth, dedicated to all your personal finance needs.